Alright folks, so today we're going to be going over the power of 3 concept. So what is the power of 3? So basically it's an ICT concept that breaks down the range of a candle. It gives us a model and a framework to hunt setups. We can use the power of 3 concepts to basically filter out trade ideas. Generally, we're buying below the opening price in a bullish market, and we're selling above the opening price in a bearish market. I'll speak a little bit more about what these opening prices are in the coming lectures. So, if we're bullish and we have an up close candle, this can be interpreted with an open high low close bar. So let's break down this open high low close bar. Number one, we have the open, the low, and the high in a bullish environment. Where it closes doesn't matter too much, because what we are looking for is number one, the open. This is what we use as our filter. We buy below the opening price. This is where the low is formed. And then what we're interested in is this expansion move higher. Where the high forms isn't again important. However, we can use tools that can predict where the high will be formed, and we will discuss that later in this lecture series. So, if we have a bullish market profile, 12 AM New York is what starts the algorithm. So this is the beginning of the daily range. So prior to the 12 AM midnight New York candle, we are looking for the daily draw on liquidity. So the higher time frame draw, which is most likely going to be a fair value gap or old highs above the market in an underlyingly bullish market profile. We have the opening price down here at 12 AM New York, and we extend that out in time. Now, if we are in an underlyingly bullish market, we want to ideally buy below the opening price. So we use the opening price as a filter. We're looking and hunting discount levels below the opening price. So price has already moved up to the 12 AM New York candle. And these discount levels can be a fair value gap, order block, breaker, mitigation block, or an old high. So initially, price moves higher. Now, what do we do here? We're waiting. We're waiting for price to come below our filter, our opening price. The market reprices below our opening price and into our discount levels, which could be any one of these. We then see a reaction higher. Our second opening price of the day is at 8:30 AM New York time. We have our opening price level when we reach 8:30 AM. We extend this out in time. Price moves higher slightly. We're looking for price to move below the opening price and into an area of discount, which can be any of these arrays down here. Notice the low, the high, and we're in an optimal trade entry area, and we're pairing the discount levels on the left hand side, and price eventually hits our draw on liquidity and then eventually goes into the close. So we have our open, our low, our high, and our close. This is how we map out the daily range. So essentially we want to buy below the opening price at midnight and below the opening price of 8:30 AM if we're trading New York. Now let's use a real life example of the Australian dollar. We have our midnight candle at 12 AM. We have our opening price that we extend out in time. Now the market travels higher. We have sell side liquidity over here, but what else do we have underneath the opening price? We have our order block, these two down close consecutive candles. We extend this out in time. And we have our high probability fair value gap with sell side liquidity resting above it. The market moves down, hits the fair value gap, inside the order block, taking the sell side liquidity, and then trades up to the buy side liquidity above this high. So essentially what we're doing is we're combining all of these different concepts together and fleshing it out so that we can build our own personal model around it. Using the opening price as a filter with discount arrays from this low to this high, we can start looking at where our high probability order blocks are and anticipating where the market should reach to if we want to go higher. So I hope you found this one insightful, and I'll catch you again in the next video.